How much down payment will I need? What is your down payment? Your down payment is the money paid toward the price of buying a home. You'll be applying for a mortgage loan, which finances the remainder of the purchase over a certain period of time. And depending on the type of loan, your lender is going to require a certain amount down at closing. And this is your skin in the game. Everybody has to put a little skin in the game. For example, if the price of your home's $1 million and you're going to put 20% down, that's $200,000. That leaves you an $800,000 mortgage over a certain period of time, which is usually 30 years. An FHA loan would be about 3.5% down, but there is an FHA purchase price limit, and the down requirement is around 5 to 10% for conventional loans. Down payments are separate from closing costs. There are a lot of variables that'll determine how much you'll pay for closing costs. However, you should expect, in addition to your own payment, anywhere from 3 to 6% of the value of the home in escrow, insurance, loan inspection, and appraisal fees, just to name a few. And this could be surprising to some. When you think, okay, I need 3.5% or I need 5% down, well, it's really more like 6.5% down or 8.5% down. And this is something that if you need help covering those type of things, that we have to figure out how we can get help from a relative or from the seller and things like that. House down payment importance. This is the lender that's giving you the money, seeing that you're serious by putting some skin in the game. And the down payment is a large initial payment made when buying a home, and it's often a percentage of the purchase price. This also demonstrates your commitment. It shows that you're committed and you're financially stable and you're making an investment in your home. It can offer better loan terms. So depending on how much you put down, you might get a lower interest rate. It definitely will affect how much, your monthly payments are. The more down, the less your monthly payments are. It can lead to affordable homeownership. So if you do have a larger down payment or have help with a larger down payment, if it's allowed on that particular loan, it can make homeownership more affordable in the long term. You can often choose how much of a down payment that you want to make. The down is dependent on the loan type. However, you can make more of a down payment if you wish, or get more help from a family member. You can buy a home with as little as 3.5% to 5% down in most markets, though there are benefits to putting down more, which lowers the payment and possibly the interest rate. 20% is the minimum down payment to avoid paying mortgage insurance. This is a huge monthly savings for you. Mortgage insurance can be a hefty payment, and it's really a waste of money because it doesn't provide you anything as a buyer. It only insures the lender against you defaulting on the loan. Mortgage loan down payment examples. If you're doing a conventional loan, it could be 5%, 10%, 20%, however much you want, but typically the minimum for a conventional loan is 5%. A jumbo loan could be 10 to 20%. FHA loan, those are a little bit easier to qualify for because they accept some variations in the credit score and debt, but they do have a lower down payment also of 3.5%, but you are going to pay mortgage insurance. A VA and USDA loan, those are supposed to be $1 down for a VA loan, but somebody has to pay those costs, the closing costs. So that means, we still have to try to get those costs from a seller, or the VA person will have to pay their own closing costs. So that's something that has to be negotiated. Down payment assistance with home is possible, and I'll talk to you more about that program. But your down payment could be as low as 1 to 2% because the program allows a down payment assistance, is what it is. Nevada Home Buyer Assistance Program. So this is the Home is Possible program, and you can get up to a 5% down payment assistance with this one. And you must choose a Home is Possible mortgage lender, and you can find those on their website, or I can refer you. And you must use a Home is Possible certified agent, which I am. And you must have a 640 or higher credit score. And the loan on some programs is depending on what you get approved for. It could be forgivable after 5 years if you stay in the home. And you do have to take the required class if you want to take a screenshot of this or ask me to send you a copy of these slides after you take your course. It's at homeispossiblenv.org/events. And then you can also visit that same website on how to get started, because you will have to take a first-time homebuyers class. Okay, so no matter who you run into for an agent, hopefully me, they will ask you if you're pre-qualified. And what that means is, have you connected with a lender? And you can pick whatever mortgage lender you want. The agent might have some suggestions if you don't have anybody that you know offhand. And this is something that should absolutely be done before you even consider shopping for a home. The home sellers will not consider you or your offer without a pre-approval from the mortgage lender. And that takes a little bit of a process. It doesn't take long, can be done in one day, probably an hour's time, or even on the phone. And you can do a lot of other things by email. But you're going to need proof of income, a list of your debts, your down payment, and where is it coming from, your credit report. A lot of people are sensitive about that, but ultimately it is going to need to be run by the mortgage lender before they're going to give you a pre-approval letter. The mortgage application process will determine what they think your rate could be, what your estimated monthly payments will be, and your approved loan amount. And then you can choose to lock in the interest rate or not. Here's a couple things to keep in mind about that. If the interest rates go up and you are not locked, you could lose your approval because you were approved for, say, 6.9%, and now they're 7.2, and it changes your payment ratio so much that you don't qualify anymore. If you did lock in, though, at 6.9 and the rates go down to 6.5, contrary to popular belief, they say they'll give you the new approved rate. Worst case scenario, you're at the lock rate. Hopefully you get the new rate at the time if it goes down. Getting pre-approved does not obligate you to buy a home and get a mortgage. You don't want to step into your dream home, fall in love with it, and later find out that the mortgage is something that you just can't do. So that's awful. So know what you qualify for going in. Mortgage. Most people know what a mortgage is, but I do want to tell you, ups and downs about it. It's generally used to buy a property unless you have cash or private financing. It enables the mortgagee, which is the person providing the loan, to take the property if the loan is not repaid as you agreed. And you might think you qualify for $500K, whereas the lender only qualifies you for $400. Why might that happen? Well, you weren't counting your debt, which they count. You weren't counting the homeowners association fee or taxes and insurance. These are things that, once you go through this process one time, you have it down. It's just the first one is somewhat of a learning curve. There's so many other variables that go into the process, like, is there solar on the house? Solar is fun and exciting, but you have to qualify for that payment unless it's paid off, or either to take over the lease or to continue the purchasing payments. So that's something that has to be looked at up front. And if you are looking at, say, a $400,000 house and then you run into something with solar, we need to know what that payment is right away so we can see if that's going to work. Your professional agent will make sure to verify all the extra fees with each property you're looking into. Some homes have multiple associations, so definitely something that you need to be aware of ahead of time. Credit score misconceptions. Banks and mortgage brokers must pull your credit to see what the credit is. This is a key piece of information to determine how much your home purchase budget is and whether you have the minimum credit score requirement for a loan. And you can get an estimated home buying budget without pulling your credit, but you're not going to get a letter from a lender that says that you're ready to make house offers until they see your credit. They're just not going to put their name on that. They want to know that they have a solid buyer, and they also have a reputation to protect. Make sure you give the broker a heads up if you don't want to pull your credit ahead of time, and you may want to just wait until you're absolutely sure that you want to proceed with purchasing a home. You might just be seeing what you could possibly qualify for and if it's even worth your time. That would be where you wouldn't pull your credit up front. But if you're serious about purchasing a home, you're going to have to run the credit. That's the only way they know if you're worthy of lending to. Consider working with an independent mortgage broker instead of one that works directly with the bank. And many of us have our accounts and our credit unions and our banks. And I'm not saying don't look at those. They just have their own programs. Sometimes they're stricter on approvals. So if you have perfect credit and low debt, and you might get their prime option. But with an independent mortgage broker, they can search around. If you have a couple things that aren't exactly perfect, they can search around and hopefully find you somebody that will give you a mortgage loan. So those are things to consider. And you could try a couple. Just remember that the bank is going to run your credit and the independent mortgage broker is going to run your credit. But they can run your credit once and search around, for you under that one credit pull. Independent mortgage brokers only need to pull your credit once, and they can go around to the different lenders and banks and help you shop for the best rates and loans possible without being stuck with stricter options with just your local bank. Large versus small down payment. So ideally, we all want to make a large down payment because it reduces our interest charges over the life of the mortgage. It avoids mortgage insurance, which could be very expensive, could be 3, 4, 500 a month or more, depending on the price of the home. It lowers your house payment and it gives you a higher equity position, although that's still your money. It's just tied up in the house. But my biggest reason for wanting a larger down payment would be to make my payments lower and to get rid of the mortgage insurance because that does not benefit me. It is only helping the bank insure themselves against risk of you defaulting. So it doesn't benefit you at all. Ideally would be not to have that. However, we're not all so blessed. Maybe first time buying a house or starting over in our life and we have minimal money. In that case, we would be doing like FHA, 3.5%, or maybe you have a VA dollar down, which is wonderful. And then we could try to negotiate the extra 3 to 5% of closing costs, depending on your situation, your buyer's agent's fees, your loan. Those type of things can be negotiated, hopefully from the seller, or maybe get some help from family. But a smaller down payment, some investors want to do this because they might want to put 10% or 5% down on their own house and then 10% down on an investment property. So they want to keep their money liquid. They don't want to put it all tied up into the house. So this is just different ways of thinking and also what our different needs are. So with a smaller down payment, though, you will have that mortgage insurance in addition to your payment if it's less than 20% down, but it does make homeownership possible for more people. And you might get not the ideal loan terms. Obviously, somebody that does a 15-year, 20% down loan is going to get the best rates and terms. So, but the idea is for everybody to start somewhere. So we're just trying to start somewhere.